Chapter 16. Leverage. My partner Charlie says there are only 3 ways a smart person can go broke: liquor, ladies, and leverage, he said. Now the truth is, the first 2 he just added because they started with L. It's leverage. Warren Buffett. Leverage is, in the context of investing, to magnify the results. Generally, leverage is achieved by using borrowed capital, but it is not necessary. You can achieve leverage without borrowed money. For example, you can buy options to magnify the results. Leverage is a 2-edged sword. It magnifies the results in both directions. If you are leveraged 5 times of your capital, a 20% move in your preferred direction can double your capital, but a similar move in the opposite direction can wipe you out. Almost every financial blow-up is because of leverage. Seth Klarman. Common leveraging tools. Common leveraging tools that are available for retail investors are 1. Borrowing. 2. Margin account. 3. Options. 4. Futures. 5. Leveraged ETFs. Borrowing. Borrowing is the easiest way to leverage your capital. You can borrow money from your family, friends, or banks. If you can make more money than the interest expense, then you made a good deal. The common leveraged investing on borrowed money is real estate investment. Generally, an investor can easily borrow 3 to 4 times of invested capital if borrowing is secured with properties. Banks are very lenient when it comes to extending loans for real estate. Margin account. Many investors who were on margin at the beginning of 2009 were forced to sell at the worst possible time. An investor who uses margin to invest can do well for 30 years and then lose everything in a single day of irrational market movements. Francois Rochin. Investing with margin means you borrow from your broker a certain percentage to invest in securities of your choice, so you can buy more than what you can on your capital. When the market is going in your direction, it magnifies your returns, but when the tide turns and your securities value goes below your share of capital, you will receive margin calls. These margin calls are usually very pressing, and investors need to send margin money within a day or 2. If they fail to post the margin, brokers sell the securities without the consent of investors. Brokers protect their interests, and you need to protect yours. Even in a short-lived downturn in the market, brokers will not wait for the market to turn around. Securities will be sold before the market turnarounds. Investing on margin has a brutal history and is the leading cause in most of the sudden market drops. In 1929, the majority of investors were on margin accounts. Those days, investors only needed to put 5% of the required capital. 95% was provided by brokers who were borrowing from banks. With the first wave of the market drop, a lot of margin calls were sent to investors who were not expecting it, even in their wildest dreams. The market was only going up for a decade, and any downturn was a distant memory. When investors failed to put margin, brokers sold the securities on market prices. Selling pressure created more margin calls, resulting in more failures and more forced selling. Investors were unable to pay brokers, and brokers failed to pay banks, and the banks started falling, one after the other. The demise of the banking system created a shortage of available credit for the rest of the economy. This dynamo effect collapsed the economy and triggered the Great Depression. The Great Depression was not the only example when margin investing triggered a sharp market decline. It happened before the Great Recession and kept happening after, although with lesser severity. Nowadays, brokers don't allow crazy leverage. However, 30 to 40% of the required capital can still be borrowed. Options. An investor can buy an option to buy or sell a security at a specified price within a specified period. The price that is paid to buy the option is called the premium. Options are an excellent way to leverage your position when you are almost certain that the price will go in the direction of your choice. If the market goes sideways or goes in the opposite direction, you can lose money very quickly. If you are a buyer of the options, the maximum risk is the premium you paid. However, in the case of an option seller, the risk can be unlimited or several times greater than the premium received. Futures. Like options, traders use futures as a leverage instrument. However, unlike options, the risk is not capped, and losses can be accumulated rather quickly. Options and futures are risky strategies and should be traded with extreme care. This is true for all leveraging, but especially for options and futures. Leveraged ETF. Leveraged ETFs are a relatively recent innovation. These ETFs give you a leveraged return of daily moves of the underlying index. For example, a 2x leveraged ETF of the S&P 500 will provide you with twice the movement of the S&P 500. If S&P 500 increases by 1%, leveraged ETFs will be increased by 2%, and so on. Investors must understand that this leveraging is only for a day and not for a period of time. If S&P 500 increases by 10% in 12 months, leveraged ETF does not necessarily increase by 20%. It will often lag the 10% return of the underlying index or may even lose the money during that time. This lag is because of daily rebalancing. It all depends on how volatile or calm the market was during that time. Let me explain with an extreme example. Suppose both index ETF and leveraged ETF start with $100 per share. Day 1 market dropped by 30%, and index ETF goes to $70. Leverage ETF will follow by twice the move, and losses will be 60%. It will go to $40. The next day, the market corrected itself with a 42.86% move price of the index. The ETF went back to $100. Leveraged ETF will follow with an 85.72% move, and $40 will increase to $74.29. An investor of this leveraged ETF will lose more than 25% of capital in the virtually flat market. That's why it is highly recommended to purchase leveraged ETFs only for a short period of time and when market direction can be predicted with absolute confidence. When to use leverage. In my opinion, inexperienced traders must avoid leverage at all. Warren Buffett said, "When you combine ignorance and leverage, you get some pretty interesting results." Experienced investors can use leverage with extreme cautions. I believe when using leverage, the following 4 conditions must be met. 1. Leverage must be in the general direction of a secular trend. In the stock market, it is the long-term growth of stocks, so leveraging should only be used for long positions. It doesn't matter how irrational the market is. The market can stay irrational much longer than you can stay solvent. Think about the 1999 market when tech stocks were irrationally high. These were irrationally high in 1998 and in 1997 too. If you short the market and used leverage, you would have been wiped out within the blink of an eye. 2. Leverage should never expire. The biggest problem with options is that they expire. Every day you lose a bit of it, and finally, it becomes worthless. More often than not, you get your desired price level, but only after the option's expiry. If you have a leverage instrument that doesn't expire, you will get the results, although after a long wait. 3. Leverage positions should not be subject to forced sell. In any circumstances, your leverage position should not be forced sell. You should be the one who decides when to sell your positions. If you are long, generally over time, the market will move in your desired direction, but you will have to survive the period of severe market meltdown. Market meltdown should be an opportunity to you, not a threat. 4. The maximum possible loss should not be more than the invested capital. Margins, short options, and futures are the common example where maximum loss can be several times of invested capital. Inexperienced traders can accumulate huge losses before they know it. If these conditions are met, a prudent trader may be engaged in moderate leveraging with cautions. All investors who have accumulated significant wealth used leveraging one way or the other. Any leveraged position must survive not only bad days, but also during the extremely unlikely black swan type of events. A 90% drop in the market was inconceivable before 1929, but it did happen. Mortgage-backed securities were considered secured because the default of thousands of mortgage loans was unthinkable before 2008, but it happened. The sudden closure of the global economy was inconceivable before COVID-19, but it did happen. Your portfolio, leveraged or not, must be constructed in such a way that not only will it survive the bad days, but thrive in a market meltdown. Leverage can never turn a bad investment into a good one, but it has the potential to turn a good investment into a bad one by forcing you to sell at just the wrong point in time. James Montier. Chapter Takeaways. Leverage is a two-edged sword. The edge that can cut you cuts deeper. Leverage has the potential to turn a reasonably good investment into disastrous gambling. If you are inexperienced, start with a fraction of your money. Don't play with money that is not yours. If you have a leveraged position,